property in a pandemic is now the time to move live webcast. So we're doing this webcast because of consumer demand. You've all been asking about what's been going on in the property market. So we decided to get some industry experts who I'll let them introduce themselves in a second. Just a bit of admin I just want to go through. If you want to ask a question, then you can do via the medium of either YouTube or Facebook. Just fire the question. I'll try and ask it of our panelists. Now, we do have an hour. Try and keep it to that hour. There's a lot to get through. We've been talking a hell of a lot before this has actually gone live. There's so much to get through, so much interesting stuff. If anybody does drop out of the show as we're doing it live, what we'll do is we'll endeavour to get them back as quickly as we can, and then we'll just keep the conversation going. So what I want to do is I want to introduce my two panelists here who have kindly come onto the show. Now, they are Verona Frankish, who's the director at Purplebricks, and obviously Ben Gallagher from Habito, commercial director at Habito. So I'll allow them briefly to introduce themselves and tell us a bit about their respective companies. So I tell you what, would you like to go first, Verona?
Sure, no problem. Good evening, everybody. Thank you for having me, Damien. It's good to be here. You're right. It's a really interesting topic at the minute, and one that's that is actually right at the forefront, not just because of my job, but because of my friends and families and everything that we're going through at the minute. So I'm one of the executive leadership team at Purplebricks, which is a technology-led estate agent, and my portfolio is I look after our lettings business, our conveyancing business, and also our mortgage business. So actually, I can cover quite a lot of the topics that are on the questions tonight. So although I will defer to Ben as definitely more of a mortgage expert than I. So yeah, good to be here.
Thanks.
Okay, and Ben.
And yeah, likewise, obviously, thank you for having us on. It's likewise great to be here. I guess it seems like everyone's thinking about their mortgage or their house at the moment and whether it's the right time to move. So great time to start talking about that and sharing some of the knowledge that we have. In terms of, so I'm commercial director here at Habito. My history, I worked for Lloyds Banking Group for 5 to 6 years before joining Habito just under 2 years ago. So I'm commercial director here, looking after all the commercial side for the business. So yeah, it'll be good to chat about everything housing.
And just to give you some context to how this panel was constructed. So obviously Verona's got the experience, like she said, from the mortgage side as well, but from the sort of estate agent side, the Purplebricks side is very interesting. But of course, Habito are a mortgage broker, but also a lender as well, aren't you? So we basically covered all bases with this panel. I mean, just to give people a little bit of admin before we carry on, the highlights of this will appear on our podcast as well. So if you want to listen to some of this again, you will be able to watch it on our social channels in the coming days and weeks. And you can catch up with the highlights of this show on the Money to Masses podcast, which is out on every Sunday. So having got the admin out of the way and the introductions out of the way, I suppose let's kick straight on with the property market. And we're grouping this in kind of, we're going to go through current market trends, buying a home, selling your home, mortgages, remortgaging, first-time buyers advice, buying and selling a second property. They're the kind of topics we're going to cover, and then some Q&As of people sending questions, and questions have already been sent in. So first of all, I mean, could you give me just a quick overview of the sense of the market from your perspective since the start of the pandemic? Because there's been quite a change. I mean, from your point, Ben, I mean, from a mortgage perspective, there's been a huge change, hasn't there?
Yeah, absolutely. So I guess we've both seen, there's been changes across the whole value chain within house buying, from the point that a customer decides that they want to interact with their housing to how they actually find finance to transact on a certain property. But then also after that, from a logistical perspective, how can they move house and things like that? So I guess heading into lockdown from March, we saw pretty significant changes across kind of business that we were doing. The whole purchase market pretty much dropped off a cliff, and that's basically just because customers were no longer able to look at any part of their mortgages, so they couldn't get out to properties to do viewings. There wasn't valuers able to go out and do appraisals on properties, and also again logistically there was no removals people, for example, to help people move house. So pretty much overnight we saw the purchase market pretty much disappear. the remortgage market and the refinancing market with customers who already have mortgages just looking to go back into the market and take a new fixed deal. That was pretty resilient, and that stayed pretty constant throughout the pandemic. From June onwards, pretty much is when we saw things start to adjust back to normality. We started seeing people more interested in transactions. We had a lot of people come to our website who weren't yet ready to transact, but they were thinking about looking for housing, wanting to understand how much could they borrow, what does that look like for them. That started again from sort of June, and I'd say now we're pretty much getting back to a normal level where we have customers coming to us to buy their first house or to refinance and move to their family house or whatever that looks like for them. So we're approaching again like I guess back towards the steady state of a mix of all types of customers.
Okay, and we'll come back to some of that stuff on the mortgage front, because obviously behind the scenes there's been some delays and bits and pieces, obviously, for people trying to buy a property now. There's lots of questions centered around that. But I mean, Verona, from your perspective as Purplebricks, I mean, that was probably quite stark, wasn't it? What happened pre and post pandemic?
I mean, we use the terminology of roller coaster very flippantly, but this year has absolutely been a roller coaster in the housing market for sure. Absolutely, as Ben just described it, you know, when the housing market locked down, it completely fell off a cliff in terms of sales. Obviously, we have a lettings business, and that weathered the storm of even the housing market lockdown reasonably well. We were able to move customers into letting property because we managed to move our entire model to a remote and a virtual basis. And because of that, it meant that we could complete the entire transaction virtually. We could do valuations and viewings virtually, and we were able to move people into their property. Of course, you're not taking a very significant risk when you move someone into a let for 6 to 12 months, whereas it would be much more difficult to take that significant risk and do the entire thing virtually if you were purchasing a property. So then, as Ben said, whenever the market reopened, end of May, early June, we saw a significant uptick. And then that was very closely followed by the government's decision to add the relief on SDLT, stamp duty. And then that literally gave another real spike to the demand. So July was a absolutely record month for us, followed very closely by August and September too. So we are seeing significant demand in the purchase market, way above last year as a consequence of that.
But is that now? Are we seeing the market at a level that is way ahead of where it would normally be? So obviously, like you said, activity's picked up, but have we just pulled forward what would be going on next year? And is this back to a level that's typical of this time of year, or are we in excess? I mean, is there like steam coming out the ears of everybody at Purplebricks and Habito trying to cope with the demand?
So in terms of our business, I would say a couple of things. There is definitely an element of pent-up demand, but there is also new demand created by the stamp duty relief. So I think it's a double whammy. We describe it as if you think of a boa constrictor. One of my colleagues has used this really great metaphor. If you think of boa constrictor as eating something that is just too big, taken off too big a bite, and is trying to move its way through this boa constrictor. So we've got this massive pent-up demand in this very tight space. Our pipeline is bigger than it's ever been before. Yes, there is definitely a significant uplift on last year, but on top of that, every other stakeholder in the transaction is constrained. So whether that's lenders, surveyors, local authorities for searches, conveyancers, brokers, estate agents, everybody is constrained, and therefore that movement along the pipeline is taking longer than it should do, than it would normally do. So there's a number of factors at play at the minute. Yeah,
and I echo that as well. I think there's a few things from the demand side certainly at play. From a first instance, you've got 2 or 3 months of people wanting to transact on houses that haven't been able to do so. So that's what you see come through in July and August. There's also obviously the stamp duty changes, which has kind of maybe got a few people who are thinking, oh, in a year's time, I might like to move. It might have pushed those forward a bit. But also fundamentally, people's circumstances have changed. People's outlook on what they want to get from housing, from their own situations has also changed. So in terms of, to your question, is it a kind of, have we just moved stuff forward from next year into this year? I'm not sure we have. I think we're just seeing a mixture of more activity from the stamp duty, but also people's circumstances and generally just high levels of mortgage activity that we see kind of all the time, all year round.
I mean, taking that point that you said about the stamp duty, now, one of the big questions that we seem to be asked, I know there's no crystal ball for this, but it's the one question you can't get away from when you're talking about property at the moment. It's about house prices. So where next for house prices? I mean, has the stamp duty, I mean, anecdotally, I've heard about the stamp duty holiday pushing up prices. I mean, I'll be honest with you, somebody a couple of doors up from me has put their property on, I'm sure as a result of this, and the amount they want for it, it's just not worth it because it's the same house as I live in. Is that a widespread issue? Are house prices high? And I mean, where do you see them going from there? I know you've not got a crystal ball, but lots of people in the industry will have a view, and you'll get a sense of what they are thinking.
Yes, I guess from my perspective, they are volatile, and they are just by nature of kind of the whole world being pretty volatile at the moment. Some of the reports, there was a report came out this morning that said they expected house prices to be up around 7% this year in the UK as an average. Interestingly, London seems to be the place that isn't experiencing that. That's broadly flat, 1-2% up year on year. It's actually the places outside of London that are really experiencing the asset prices going up. And I think that's just a function of what you see, what you hear when you're talking to your friends around, is it the right time to move out, have a bit more space? I could be remote working for another few years. And I think we're seeing that. In terms of how that plays out in the long run, so I guess there's a few risks. The first being when the stamp duty changes end in March next year, what does that look like for the property market? But also fundamentally, I feel like we have people at the moment making longer term decisions with their transactions. So people are looking at buying properties for 2, 3, 4, 5 years time, which hopefully brings some kind of stability into the house prices in the future. I don't know if that's what you think, Verona.
I would echo all of that, Ben. And I saw the same report that you did this morning. And yeah, I think there's definitely growth in house prices, and we're definitely seeing that pretty much everywhere outside of the two areas that we're not seeing that growth is Aberdeen because of the oil industry and central London. But elsewhere we're seeing house prices growth, and on average it's around between sort of 3 and 5% at the minute. And it looks like it'll peak out at about 7% by the end of this year. I mean, whilst the housing market over the longer term is obviously reasonably robust, it isn't immune to the economic impact of what the pandemic is going to do, because, you know, we still have the economic impact to play out. There is a suggestion that unemployment is going to be at 8% by the end of this year. That clearly will have an impact on the housing market. And it's more about affordability. So, yeah, you're right. We don't have a crystal ball, but everything suggests that whilst the stamp duty is in play, or the stamp duty relief is in play, they will continue to rise. But there comes a point where if you haven't sold your property, and honestly, it's probably reasonably close now. If you haven't sold your property by the end of October, the chances of that transaction completing by the deadline of the 31st of March is highly unlikely. So bearing in mind everything that I said earlier about the constraint on all the stakeholders within the transaction, that is putting a lot more pressure, and it's taken longer to complete those transactions now. So unless the government extends that deadline, we could be in a little bit of it could be an interesting position early next year. Yeah, with a lot of people in the pipeline that may not complete.
I agree with that, and I echo your thoughts. It seems to be getting towards the time now where you're going to have to start, if you want to take advantage of that, start kind of thinking about selling or buying right now. The one thing that I always think when I talk about house prices and what they look like in the future and what they look like now is that for most people transacting on houses, buying and selling, the chain is a point in time decision. So in some respects, it might be really good that you sell your current house for more than you thought you would. But there's the other end of the spectrum that says you have to buy somewhere to live in now, so you might be paying over the odds to live in there in the future. So because at a point in time, if you get a good deal on your house, the likelihood is you probably won't get a cheap deal on the house that you're buying. So it's just an interesting dynamic.
And the other factor, of course, is the mortgage rate that you're going to get at that time. So if you have to put in a bigger deposit, and that might cause you some other challenges on your disposable income, if you get, when there's less pressure on the housing market, you may get a better mortgage rate over the longer term. So, it ebbs and flows. And because property is a long-term investment, and you're not buying, unless you're an investor, and most investors buy investments for the long term anyway, I would always guide to think of the longer term, not just the next 6 months or whether you're going to save on stamp duty. There's other factors at play.
Okay, so touching upon one of the things that you sort of mentioned there, Verona, on the cities. You mentioned London,
sure.
And it wasn't enjoying the same uplift as you see in other places. What about the trend? Because you were talking to me before we came on air, actually, and you were talking about the dynamic you're seeing in the market is changed quite a bit in terms of rental and even house purchase, particularly in cities like London.
Yeah. So anecdotally, as we've all been talking to different people over the last number of months, we've seen a lot of people assessing where they live, what they want from their property. And historically, a lot of people lived in London and paid over the odds for their property because they had to live close to the office, or they wanted to be closer to tube lines or train lines, and they traveled into the office every day. As the pandemic has hit and we've all learned a new way of working, and companies have been facilitating remote working because they've had to, we've sort of fast forwarded our work from home regime as a country by probably 10 years in the space of 3 or 4 months. So as a consequence of that, what we've seen in the property market is that people are choosing not to live in a 2-bed apartment without a garden because they want a bit more space. They're realizing they don't have to be close to the office. They're happy to be in the suburbs. They're happy to be further away from the office, happy to come in maybe once a week or even, a couple of times a month, but they don't need to have that commuter close distance to the office. So what that's meant from a rental perspective is we're seeing in September, for example, 70% more rental stock available in London than the same time last year. Now that's completely contradictory to the rest of the country, where it's about 30% down year on year, because people are deciding they need to move out of London, but they don't necessarily want to buy right away because they want to choose where they live or take a bit more time. So we're seeing a real spike in demand from tenants who want to move to suburbs, who want to move out of London, and a real spike in properties coming to market to let in central London, which has been a really, it's so stark when you look at the data. And then if you look at the other side of it, the demand from a tenant in the rest of the country is higher than it's ever been, but demand as tenants for properties in central London is only just up year on year. So I think it's about 3 or 4% up. So that has impacted then the rental yield and the rents that can be charged in central London, but also outside of London, it means that rents are on an upward trajectory. So it's really interesting.
That's having a knock-on effect to the whole buy-to-let
Absolutely
market. It's changed the whole dynamic, particularly in central London. I mean, Ben, are you seeing similar changes in the mortgage lending market? So I'm thinking more about the types of customers that you're getting pre, post, during pandemic. That's obviously had a shift.
Sure. I guess most relevantly, to touch on the buy-to-let sector, as you just mentioned, it's probably never been as buoyant as it is today. And I think there's a few things that lead into that. Like you say, the demand for tenants has never been greater. So it seems like a pretty good investment for buy-to-let landlords to deploy their cash today and make those choices now. And the other point is that if landlords have been building up deposits, basically, that they want to transact in houses now, or they were thinking about doing it in the short term anyway, there's probably never a better time to do it than now. And that's pretty much because of the stamp duty changes that have come into place. So normally, as most people may know, or some may know, generally buy-to-let landlords, if they're transacting on second, third, fourth properties that they want to let out, they would pay roughly a 3% premium on the stamp duty charge that they would otherwise pay. Now that obviously, whilst they still pay that 3% premium, that's now for properties up to 500,000, that's a premium on 0. So they make big savings transacting on their houses now. And I think that's just what we're seeing. And some of our partners, so we see it a lot at Habito, but also some of the people doing the similar stuff that we are in the buy-to-let space a lot heavier, they're echoing what we're seeing as well. It's been a few of the busiest months that they've ever seen, trying to get all of these kind of pipelines of transactions getting flowed through as quickly as they can.
Okay, I mean, so moving on in the conversation to like rather than from the trends now going on to sort of more of the buying side of the equation. I mean, I suppose this one for Verona. I mean, are you seeing a particular demand for sort of styles of homes now? Is there a particular trend we're seeing? Obviously, the movement for people out of London, for example, but are there particular types of property that are proving particularly popular at the moment?
Yeah, and again, this is something that anecdotally I see when talking to people, but also we're definitely seeing in the data from a property perspective. So there is definitely a much greater desire for gardens, for offices, home offices, or space where we can build a home office in the garden, for example, or a working space somewhere in the property. It doesn't necessarily have to have one today, but the potential to have one, they're becoming much, much more important. We've even as a company, we've seen that it's been really challenging for some of our people. We had to move our entire team in the space of 3 days to work remotely. And for the most part, that worked brilliantly. But a lot of people weren't necessarily set up to work from home because they didn't have the need to do that prior. And, they all had makeshift offices in the corner of the bedroom or on the kitchen table. But actually people are now, exactly. And you know what? It's been challenging. And we've seen some brilliant team building through that, where you've got a child on the side or a dog on here. Yeah. And it's been fantastic.
I'll be honest with you. I'm still hoping a child's going to wander in the back of one of your feet. It's the sort of thing every time I'm on a call, I'm always secretly hoping they're going to be ruined by a dog or an animal come on, because I just think that makes part of what this is now, and I love it. But
it's our new world, right? I have to say, I've got an outside office and I've locked the door, so nobody can actually come in.
But previously, I think it is just a reflection of the kind of new world. I think previously, if you see these children come onto camera, the person who's presenting or whatever would seem just a bit more awkward, whereas now I find it even more weird if they don't like invite the child on to say hi, or it's just more of people basically.
Yeah, absolutely.
Yeah. But I've noticed, sorry, is another point is I've started to notice that some of the estate agents are actually putting in their the particulars for property, emphasising about potential for home offices or that kind of thing a bit more, where it would never have been mentioned previously.
Absolutely, and we are actively finding ways at the minute where we can, if someone searches for an office and there isn't one, a way that it can filter into the search that says space for an office in the garden or opportunity to build, because actually it doesn't necessarily mean that you have to have one today. There just has to be the potential to have one or to create a space. And, honestly, that's going to be one of the most sought after features of a property as we, go into the next 12 months, because more and more we're seeing that's what is what people want. B, and we're having the conversation previously about, we haven't really seen the fallout yet to understand, are we as productive? Will we be as productive longer term? What do we lose out by working remotely, by not having teams around us and our relationships and all of that sort of stuff? And we haven't yet figured that out, but we have to find the new norm and a new way of working for everybody in order to embrace this, the world that we find ourselves in. It's different, right?
Yeah. I mean, keeping with the property buying theme, and Ben, one of the things that obviously now lenders are understandably looking at their book of lending and are being a little bit tougher, stricter, but what is it that lenders are looking for now? I mean, if you're going to go buy a property, your dream home, and you decide that you're going to pay whatever for it, what are lenders nervous about, or what are they looking for when they're actually trying to assess whether to lend?
Yeah, so to tell you the truth, not much from that perspective has changed. They are still cautious around the same things that you would expect them to be cautious about, and still get comfort from the same things and longer term employment and what that looks like. They're obviously keen and very hot on that at the moment, given the unemployment forecast and things that we might see towards the end of this year and into the beginning of next year. The second is obviously they have some nervousness around valuations of houses. So that's why you see not very many of the low deposit products in the market at the moment today. It's just the risk essentially lies with that lender. And so it's very understandable with the uncertainty among everything, not just in housing, that that they just they haven't got that increased appetite for risk to take on at the moment. So in general, it's not too different, the things that you look out for. And in terms of where they get comfort, like I say, the employment side of it is obviously very important. The deposit side equally is very important. But fundamentally, there's 90 odd lenders in the UK, and they're all kind of competing against each other to offer compelling products to consumers. So I think that's just a fair balance of what you see, and the kind of mixes that you see is pretty fair enough, I'd say, on the lender's part.
Okay, so I mean, one other thing that on property prices, say you find a property and you're going to make an offer on it. I mean, are properties going for the offer prices? Like, take the property down the road from me. Are people on a whole paying the asking price, or are people overvaluing their properties? Because is there also a case from the lender's perspective that valuers going in for the mortgage companies are, in a way, threatening a lot of these deals going through because they're putting in an extra margin on the property value for the lender? Are we getting that, Ben?
Yeah, so a bit. So probably not to the extent that you would say it's a big issue. And the kind of value of your house and the level of deposit that you would get, you need to have your mortgage product or whatever kind of working hand in hand. So yeah, you've probably seen a bit more prudent activity from valuers doing valuations on houses. That's to one side, benefits the lender, is probably less favourable to the consumer. But equally, because there's not as many low deposit products on the market, what you're actually seeing is some more people taking on these mortgages with already they have more equity in that house. So they build themselves kind of a bigger buffer to be more resilient against any shorter term changes in the house prices. Now, that alongside that, some lenders would use, they wouldn't even need to get a human to go and see that property. Some would use kind of desktop based or automatic valuation methods to do an appraisal of a house, you know, that are based on confidence intervals and a view over 2 or 3 years time. So yeah, I think there is some of that going on with the valuations, not too much. And also I think from my experience, and we'll be able to share more, I think, from Verona, is that in some circumstances, I guess people do put their properties on for a bit higher, and there's a real trade-off between putting a house on for a little bit less money and getting a lot of activity. And who knows, you may get someone bid over the asking price versus putting it on for too much, having less activity and having someone bid under the asking price. The you have to have buyers to sell your house, and so you end up meeting in the kind of market level for that price, for that property.
And Verona, I mean, what are you seeing on that side of things in terms of, I mean, I know it's a very big market. It isn't all just, you can't have one answer to all of this, but what are you seeing from that kind of offer to asking price?
Yeah, I mean, I think generally our ethos as an estate agent is to do a fair assessment of the value of the property within the market today. I think what we know is that the market can ebb and flow, and it goes up and down based on things like stamp duty changes. But you know, the market dictates what your property is worth based on comparables that have sold in your area and the knowledge and the expertise of the agent that you use. So we often speak to customers who believe that because something like this has happened, that there's an extra 10% or 20% premium on the property value. And, you know, we have to assess or discuss with them the realistic price that we believe it will achieve. To Ben's point, absolutely, we believe putting it on at a fair price and increasing the activity and the viewings for that property is much, much more important than putting it on at an unrealistic price, because what happens is it doesn't attract the attention to start with. Then we have to do a price realignment that takes it back into where it should have started with. And then the assumption from a potential viewer or potential buyer is that there's something wrong with the property. So that's never a good starting point when you're putting a property to market. So the best thing to do, and the best advice we would always give, is to put it on at the realistic price that we think it will sell for, attract the most attention for that property, and then potentially, you know, enter into negotiations with maybe 2 or 3 very keen buyers.
I mean, on that though, you say about, like, obviously attract attention, but how do you do that? How do you make your property stand out? Because obviously there's a number of properties that people look outside their windows and start to see people who are probably being opportunistic and thinking, do you know what, I might move. And so you've got a bit of increased competition that maybe wasn't there previously. I mean, how do they make their property stand out?
Oh, there's so many things that we advise our customers on to make the property stand out. And one of the most important things is great photography. One of the most important things is have great photography. So whenever this world does this all the time, whether it's right, left, up or down, we're constantly scanning. We scan everything. And of course, we know now that we don't go into estate agents' offices to look for properties. Our go-to is Zoopla and Rightmove. That is for the most people who are looking for property. So, and with the amount of property they're on there, you have to have photography that stands out. We are clearly utilizing virtual viewings much more prominently than we've ever done before. So there's lots of tools out there that we can do that. So video tours, whether that's a Matterport or a virtual viewing through a video, or video tours of photographs, anything that stands out and is a little bit different, that allows customers to browse and do a lot more desktop assessments of a property, will definitely attract more attention. Now, the reality is, in this world, it's harder and harder for us to go to physical viewings now, because we've got local lockdowns. Wales have gone into lockdown today for the next few weeks. There's lots of challenges in that. So the virtual world of being able to make assessments has become more and more important. And I have a feeling it's going to be like that for months to come. So making sure that you have a great online presence and good photography that represents your property fairly is a really, really important thing. Because we've just done a survey from a lot of buyers and asked them, what are the things that are real turn-offs for you? What things would you not want to see a property? And in the top 5 was misrepresentation on room size. So don't give me really, really wide angled lenses and I walk in a room and it's a cupboard and it looks like a massive drawing room. So things like that, things like overgrown gardens. Don't have an overgrown garden. A neat garden, dirty laundry and shoes on display in your photographs, things like that. Basic principles of good photography and showing your property in its best light.
And on taking that, sorry, Ben, you want to come in there?
No, it's the same again as going back to what we were talking about house prices, that when you sell, you also have to buy at the other side. And I kind of see it in the same way. Like, imagine what you're looking for in the pictures of houses that you're looking to buy, and then try and reflect that kind of stuff in the own pictures of your own house that you're trying to sell. Because generally speaking, there's like a value chain that needs to be fulfilled, both from you selling and you buying. So it kind of works in one long chain, like most things, I think.
I mean, leading on from this is still in the selling element of property. There was a question that we actually had come in, which is something that I think a number of people have thought about, is the idea of selling their property and then renting elsewhere and then buying later. In a weird way, not sort of taking advantage of the stamp duty holiday themselves, but just that demand that suddenly picked up for people wanting to, say, move out of central London or something like that. I mean, what's your view on that? Is that like a good idea? Particularly, I mean, Verona, based on what you were saying about rental yields, how that's all shifting as well, because is it a case of out of the frying pan into the fire almost?
So I think when you're selling and then buying onwards, unless the two things align perfectly and you sell your property and you buy the new one, then and that happens in many cases, but there's also a lot of cases where someone is selling the property and it's a good time to buy and they get a good price, but they can't find the property of their dreams, and or they don't find the property that's right for them at that time. Absolutely, renting for 6 to 12 months, assessing a new neighborhood or a new community or a new area is a really, really, really good idea for a number of reasons. One, you're not jumping into a long-term commitment in an area that potentially may not be right for you, particularly if you are moving, out of London or out of a city into a different area. But also it puts you in a really strong position, a really good negotiating position when you're selling, and it's there is no dependency on a purchase, and equally when you're buying and there's no dependency on a sale, because in both cases you're compromising on a lot of things, and that when it gets down to the deal, you're having to make compromises with the buyer or the seller, whereas it puts you in a really strong position if you're only doing one of those things at any given time. Clearly, it's a bit of upheaval if you have to move into a different area. If you move in a family of 5, for example, and you're having to move twice, that's a bit of a faff factor. But actually, if you can do that and manage it, it's a very wise choice to do if you can't align the two things together in the right way, sensibly.
Yeah, I really echo that as well. In particular, the point around it putting you in a strong position if you don't have a chain in your transaction. So we did some research last year that said people who are cash buyers generally make around a 5% saving on their property transactions, and that's purely just because they have no other hassle within that mortgage chain that is dependent on that whole chain completing. And it is the nature of these things. They often happen in long chains, and so the person that effectively breaks that chain ends up playing quite a valuable part. And also from my perspective, it's just understanding like that your housing transactions generally aren't short-term things. So you should do whatever's best for you, whatever kind of sets yourself up best to kind of make a longer term decision. And if that is you stay in your house today a bit longer and you forego the stamp duty saving that you would have made, I think in the long run, that's probably good if it means to a better decision that you make in the long run. And also the stamp duty is only one part of the fees and the costs and the hassle that you go through in your kind of transacting of houses. So for sure, it's great and it's a really good thing, and it's definitely prompted a lot of activity in the market. But also there are other fees, there are other hassle that means if it's not right for you at the moment, it's probably maybe for some people not enough to make them transact. But that's just so dependent on your circumstances, your certainty, and what you want to do.
I mean, I just want to tie that into, actually, there's two questions we've received in. So don't forget that people want to send their live questions in. We'll try and answer them. And it relates quite nicely to this question, actually. And it kind of goes back to the property price bits we were talking about earlier. And Gary asked about, are house price / letting increases sustainable? Or does the panel think there could be a correction in the next 12 to 18 months once schemes come to an end, such as furlough and mortgage holidays, etc.? So if you can see how that links into that question, really, because you would take advantage of a correction if there one did occur. So you would actually sell high, buy low, basically. I mean, what's your view on that?
Do you want me to go
first?
So
Ben, you go first.
Yeah. So I mean, hard to say. Is there possible that there is a correction? Yes. Is there also possible that there might not be? Absolutely as well. It's so kind of dependent on, it's multivariate basically on unemployment, on wage inflation, on various things that would lead to kind of your house prices increase. So I guess it's good to be conscious basically of the uncertainty that you face in the future. And that's why I come back to the point, whereas I think your house transacting it's not over a 12-month time frame. It's certainly on the purchase side, maybe on the rental side it might be, but if you're looking to enter the kind of purchase market, generally what you see, and I even if you take it back to the kind of worst example that we can pick on from 2008, from the house price, from the housing crisis, generally what you see is if people held their houses for long enough, they wouldn't really be that vulnerable to a shock. Now, there are obviously nuances to that, and there are obviously places in the country where that hasn't been the case. But generally speaking, for the majority of people, provided you held your assets for 3, 4, 5 years, you're actually not that vulnerable to a short-term shock. And so I just think it comes back to making rational decisions, making sure that the value that you put on that property is the price that you end up paying. Don't get caught in the, I really want it, so I'll pay an extra 5%. Just be conscious to stick to what you think the value of that property is. And I think that's how you should base your decision making.
Okay, so moving on just more to the mortgage part of things. A really popular question that came in various guises is, should you get a fixed variable or tracker rate mortgage at the moment? Because obviously, just to give that context, with base rates so low and with talk of negative interest rates and things like that, I mean, what is your advice, Ben?
Yeah, so I guess the first thing to stress, otherwise I'll be in trouble, is that you should always seek professional advice from mortgage advisors.
Let me just reiterate that for Ben. Nothing that's spoken about on this show is anything advice, and that goes for anything that's said. But yeah, so I gave you a bit of a hospital pass there. But yes, what's your view?
Yeah, so, I mean, generally speaking, what you see in the UK market, and you have done for quite a long time, is the vast majority of people take shorter term fixed products. So they'll fix their mortgage for 2 or 5 years, and then after that period of time, they'll refinance and do another 2 or another 5-year product. Generally speaking, that seems to be right for most people in the UK today. They like to have some form of certainty, 2 or 5 years, but they also like the flexibility that if they want to move house or their circumstances change, they can react in 2 or 5 years' time. Now, there are some circumstances where that doesn't hold true. So it could be, I'm a year away from moving house, so I need something to bridge that gap. In that circumstance, it might make sense to take a tracker or a variable product. But generally speaking, in the rate environment that you have today, the interest rates have never been lower for mortgage products. They have never been as low as they are today, particularly on the 5-year front. You can fix for longer, as cheap as you've ever had to be. So generally speaking, we're seeing people take the 5-year mortgage products a lot more than we ever have. And that, if you're asking what would I do, so I recently refinanced on my property last year. I took a 5-year fixed rate product. That's because, as based on the same assumptions of what I've just said, rates have never been as low as they are. I don't think my circumstances are going to change in the next 5 years, and so I wouldn't be vulnerable to paying any penalties or anything that I would otherwise experience. Because that's the thing you have to really weigh up when you're looking at this decision: is how are your circumstances going to change within that period? And if you don't think they are, my advice would be take a fixed rate for as long as you would like. If you think they might change, just be aware that sometimes you have to pay penalties to exit on those products, and those penalties can be quite big. They can be 2, 3, 4% of the outstanding value of your mortgage.
Okay, I mean, we've got more questions coming. You've just actually answered one of them, Ben, about the different terms, 2, 3, 5, and 10. Are we seeing more people take 10-year term mortgages? Because they were sort of, it was one of those things. I think the government would love people to have long-term mortgages because it would help them when it comes to economics and interest rates. Are we seeing more people take 10-year mortgages?
Yeah, so, well, recently, I think Boris was saying last week or the week before that the government want to promote longer-term fixed-rate products and try and get people to fix their mortgages for longer. In reality, today in the UK, they're a small part of the market. Around 1% of people take 10-year fixed-rate mortgages or longer, and there's not that many of them on the market, so you often pay a bit of a premium to take those products. Now, that's not to say they're a bad thing. They're a really good thing for people in those circumstances who... I can give you an example. My brother-in-law, they bought their family home, and their plan is to never move house again. So he's taken a 10-year fixed rate mortgage because he just doesn't really want to worry about his mortgage, and he knows if he takes 2 of those, he's paid his mortgage off, and he's laughing. But generally speaking, they don't exist in the UK in high numbers. You just see the vast majority, over 90% of people, taking the 2 and 5-year products. That's not to say it's going to always be like that in the future. There are definite benefits to offering long-term fixed rated products, particularly if there's some way that lenders could work out how not to penalize customers should they want to refinance within that 10-year period if their circumstances change.
That also fits in though with the average tenure that someone stays in a property is 7 years. So if that's the average tenure of someone stays in a property, then the logic of tying in for 10 years doesn't stack, because we know there is penalties to get out of that early. So Ben's absolutely right. Unless there's a better way of getting out of that without paying a significant penalty after 7 years, for example, then 10 years will always be a challenge.
Yeah, and we're the UK are actually pretty much the anomaly in that. If you take a look across Europe and in the States, they generally take longer fixed rate products. So in the States, it's often it's pretty common to take a 25-year product and then like options every 5 years, so you can change your decisions every 5 years. I know in the Netherlands, it's really common to take long-term fixed rates, and that's just the customer base there wants that long-term certainty, and they see this mortgage as something they're going to have to pay for their life, and they don't really want to have to keep interacting with that. But I mean, with the services like we offer at Habito and other brokers as well that are available in the market for free, it's actually not that painful anymore to start retransacting on your mortgage.
I mean, so moving that on now, because it's actually, you touched upon a couple of interesting points. We just had another question come in, which links to what you've been saying. It's from Callum. I just want to say, it says, great session all. So we always like a compliment. That always bodes well. It makes your question more likely to be answered. No, it said, what would your advice be for a young couple or young couple looking to buy a house? We're in no rush, but are in a good position to do so. Is it worth waiting until the pandemic is over? So it's a good sort of segue into the next section of what we wanted to talk about, first-time buyers. I mean, Verona, what's your view on that particular question?
So I think a couple of things I would say on that. You need to be super clear about what it is you're looking for in your property. So if, make a list of what your deal breakers are in your property. And if you're in a really good position, you're not in a rush, it puts you in a really strong position. So what do you want to pay for it? get a good advice from a mortgage broker in advance, so that you know that you'll be able to balance the cost of your new property along with the lifestyle that you want to lead as you're still a young couple. You know, that's really, really important. Don't put yourself under so much stress in the early days just to own your own property. So I think, you know, make a list of what the deal breakers are, what you're looking for, how much you can afford to pay, etc. And then always be on the lookout for the right property. It puts you in a brilliant position if you're not in a rush, you're not forced into it, you're not having a baby, you're not having, you know, there's no reason from a work perspective you need to move. It puts you in a great position. So be very clear about that. And then get yourself listed with, as an applicant with estate agents, or for notifications on the online portals to bring properties. Feed in what you're interested in, and then they will flag to you the properties that that match your criteria. And on that basis, you'll see then, and you'll get a very good idea of what's on the market against your criteria. It is, and this goes back to what we've both been saying all along this evening, property is a long-term investment. You know, you may save a few £1,000s if you buy in a rush today in terms of stamp duty, but you may also pay over the odds. So if you're in this for the longer term, you don't need to rush. Yeah. It will ebb and flow. It will ebb and flow. What you save here, you may have to pay on a higher interest rate, or you may have to put more of a deposit in. You know, whenever the right property comes along, go for the right property. It's a long-term investment. You're probably going to be in it for 5 to 7 to 10 years. So don't rush into it, would be my guidance.
Well, on that point, I bought my first home 13 years ago, and I'm still in it. I'd never planned to be. At that point, it was in the market. Everybody flipped their houses every 2 years. So just as a word of warning to everybody, I'm still in my house 13 years later. So it doesn't always quite work out how you think it's going to. And we end up having to extend when we had children. But I mean, Ben, your view on that, because I mean, it's particularly interested from the side of like mortgages as well, because I see these headlines that I'm not going to name the newspaper today, and it was saying that you have to have a 40% deposit if you're going to be a first-time buyer, painting the picture that first-time buyers who were about to try and get on the property ladder, now that's a distant dream. I mean, I'd be thoroughly depressed if I was a first-time buyer reading the headlines. I mean, what is the reality from inside the industry? Yeah,
so the reality is it may be not quite as bad as that newspaper was suggesting. I don't think you do have to have a 40% deposit to be a first-time buyer in the UK today. Now, that said, it isn't the easiest time to be a first-time buyer and enter the property market. There's volatility around house prices, and without the experience of perhaps going through the whole cycle once before, you might be at a bit of disadvantage going into it today. There's the stamp duty, which seems to benefit other people, other buyer types more than it does first-time buyers, because otherwise first-time buyers get the stamp duty relief up to £300,000 anyway. So the relative benefit is a bit smaller for first-time buyers. On the deposit point specifically, that's probably where first-time buyers are at the biggest disadvantage today. And that's just because of the lack of low deposit property products that are available for people that want mortgages. So what we've seen is, whereas historically it was the norm for all of the lenders in the UK market to offer first-time buyer products up to 95% loan to value, so just 5% deposit for those customers, we've pretty much seen those 95% products disappear overnight from the lockdown. What we see today is, generally speaking, good availability of products up to 85%. So if you've got a 15% deposit, great, you're still in a good position to transact on your house. And there are some products starting to re-enter the market with 10 and 5% deposits. But what you find is, because there's less competition now in those spaces, the interest rate that you pay and the affordability that you have on those products is a lot more strict, and you are just getting a lot less favorable terms to transact. So it is more difficult, without a doubt. There's less products that are more expensive, and generally you need a higher deposit to transact on your house.
But what about gifted deposits? Because again, people have read in the press about some lenders not liking gifted deposits, deposits from like family, parents or something like that. Is that true? Is that the case? Or
generally speaking, no, it's not true that lenders don't like them. So generally speaking, they're fine. They would ask you to often sign a gifted deposit letter just to state that it's a gift, and there's no opportunity that this would have to be repaid to whoever's gifted that in the first place. But generally, that's not so much of an issue. Lenders are fine with whatever the deposit looks like, so long as you can prove that that's not going to be an issue in the long-term future. It's more, like we said earlier, around the valuation of that property, and just making sure that lenders are comfortable with that, and they're not taking on any risk that in 1 or 2 years' time that they can put people in negative equity and things like that. And that's why we don't see the products at 5% deposit and things like that.
The other thing to add is that obviously Boris has been talking about generation buy, and I don't think any of us are really clear just as yet about how that's going to look. But clearly there is an agenda to help first-time buyers as we come through the other side of this. So perhaps the stamp duty changes. You're right, Ben. They definitely advantage other house buyers more than first-time buyers, but maybe the plan is on the other side of this that first-time buyers will get a boost as well. So it's just worth looking out for any more news on that.
So we're getting quite a lot of questions coming, so I'm going to just jump in between them. Verona, one for you actually. Somebody's asked, and I've lost track of who it was, apologies, because of the questions have come flying in, about negotiating down on a property price. So they're looking to buy and they've seen the asking price. Are there any tips about how you could negotiate a lower price?
I guess my first question would be, are they using an agent? Because that's absolutely where an agent will come into their own. That is their job, to help you negotiate on a price. An agent will know the seller's motivation, so what they're basically their bottom line is in terms of what they can take from a property, and where they're moving on to, and what that likely to mean, and their best place to put that deal together. So I would absolutely put that in the hands of the agent. If they're not using an agent, then the best thing to do is just be upfront. Just be upfront with the seller. Just be honest and transparent. And in my experience, by doing that and by putting your cards on the table and just saying, I really want this property, this is as much as we can go to, this is our best and final offer, and we really want to, we'll love this property, can we do a deal at that price? But if you're using an agent, absolutely, that is their job. That's their bread and butter. So they should be doing that on your behalf.
Okay, one for you, Ben. Beth has asked, what's your opinion on porting a mortgage in the current environment?
So it's perfectly fine to do, and is an option that you have available. And I guess for those who don't know, porting is generally, if you're moving house but you're tied within your fixed period, what you can do is take that fixed rate that you have with the lender, move that to your new house. But generally it's often people would take a further advance, or they'd take another mortgage to top up and be able to afford their new property. So generally fine to do, and generally lenders haven't gone port off, not going to stop you from porting their mortgage generally. What I would say is the nuances that can be a bit more challenging around porting is that I've found in my experience is around maturity dates. And that's if you were to move and port your mortgage and take an additional mortgage line with a bit more lending, generally what happens is they don't come to the end of their fixed rate at the same time. So when you come to refinance, you end up kind of refinancing your mortgage in half, and then half again, and then half again, which can be a bit frustrating. The trade-off is that you let one of them roll onto a variable rate for a few months and you end up paying a bit more interest. So in my personal view, porting isn't the perfect outcome. It's there as a tool if something has come up, someone's circumstances have changed that they weren't expecting. And as a result, it's a tool that allows them to kind of move house when they otherwise couldn't. Generally speaking, I would try and avoid that type of thing and try and get to a point where you can transact on your property with less kind of strings attached.
Okay. Verona, again, we're flipping back to house prices again for you. I mean, somebody's, I think, trying to be a little bit more direct and like on the actual percentage that people usually negotiate your price down. So I know it's one of those, how long's a piece of string, but are we talking now that people is like 5%, 10% is okay, like 5% below the asking price, or are you being cheeky? Because I suppose you always used to hear people say, oh, it's a buyer's market or seller's market. That's always those terms, if that actually ever truly exists. What is it now? I mean, would offering 5% below, I mean, what would you do?
Oh my goodness, that's a really difficult question, because it very much depends on the individual market. You know, if I was buying in London today, I would definitely say it's a buyer's market. If I was buying outside of London in one of the commuter belts, I would definitely say it's a seller's market. So it very much depends on the micro economy that we're talking about. Yeah, you know what? It depends on how much you want the property, how strongly you feel that you've done your research and what you think that property is worth in your area. So if you don't trust the guidance that you've been given, do your own research. There's enough online at the minute to see what's going on around the area. And if you really want the property, then, you know, be bullshy and put in a cheeky offer. But you know, if you want to go 10%, you run the risk of doing that and insulting the seller. That's the only thing I would say. You know, if you really want the property, play it cagey, but do your research first, and don't just go in with a cheeky offer off the cuff. Do your research, go in with an offer based on some data that you've got to support that offer. But yeah, just be prepared to lose out if you go too cheeky.
But Ben, if we flip it around the other way, so let's look at it from I mentioned them earlier, the valuers who go around from the lenders. What sort of thing are you seeing when they they value a property below what the person was hoping to buy it for? I mean, what sort of margins are you seeing on those when they are under the asking price? Is there a commonality between it, or is it just random?
No. And I guess frustratingly, it's a kind of shortish answer, because we haven't really seen it that much. Like, down valuations are definitely a thing. They're possibly a bigger thing in the buy-to-let space today, when landlords are looking to take out capital of their existing houses and things like that. Generally, in the residential space, we're not really seeing down valuations. Often what happens is the seller would have or the buyer would have a view of the value of the property, and the valuer would say, is it reasonable that the property could be worth this much? And to an extent, it's an opinion-led thing. Like, they just have to have a view of that property within the comparables on the same street or in the same area of what that property's worth. And we haven't really seen too much down valuation activity.
Okay. I mean, and another one for you, Ben, because I'm conscious of the time, another one that came in quickly on mortgages is, I mean, what's the attitude you're seeing of lenders towards self-employed or small business owners? Because obviously it's quite a fragile environment at the moment economically.
And similarly, so to echo the first-time buyer point, it's harder for those at the moment to transact on their mortgages. And that just comes back to what lenders look for, what I was reiterating earlier. They essentially look for some level of certainty that these customers are going to be able to repay their mortgage over the long term. And with all the forecasts on unemployment, they are naturally more cautious against those type of borrowers. They may ask for a longer period of time of proof of income, some certainty around future employment and what that looks like. So without a shadow of a doubt, it's more challenging. The best thing to do, kind of as ever, is speak to a mortgage advisor, because they're the ones that are talking to the lenders every day. They're the closest to it, and they'll be able to advise you on how best to position yourself in a way that is favourable to lenders.
Okay, and another point now, I suppose, which for both of you really, which is if you are, I suppose it's more from a mortgage perspective, but obviously there are a lot of people who are looking to buy a house next year, and they're looking to sort of get all their ducks in a row, particularly from their financial perspective. And I know we had a question which that was sent in ahead of time, and I think I shared it with you, Ben, that somebody's asked about. They had a particularly, not a terrible credit rating, but it wasn't perfect. They'd had a 1 or 2 mishaps in the last 4 to 6 years, and they were wondering what they should do in the interim period before they look to buy in the next sort of year or so. I mean, any quick tips you guys have got on that for somebody who's looking to get into the market, but they're not perfect at the moment?
So from my perspective, from the mortgage world, so there are products available across the whole spectrum of pretty much people's credit history, and naturally you pay a premium for your products the worse your credit history. So my advice would be, do everything you can to kind of improve your credit history. And the example you shared beforehand, that customer, that person was doing everything they could. They were taking a credit card, using it for a small amount and paying that off every month. That's the type of activity that you just need to be doing over a longer period of time to start boosting your credit profile. Generally, what you see is some tiers where you have the high street banks, basically, who have the cleanest credit profile. And then if you're not eligible to get a mortgage from them, that doesn't mean you can't buy a house, and it doesn't mean you can't transact. There's a big market. There's over a 10 billion market in the UK of people who have some adversity on their credit, and they're still transacting on mortgages. They just might go for a lender that's not a household name, but they're still doing lots of activity, and they're still prudent in who they lend to. So do all you can in the short term and the medium term to improve your credit profile, but also visit a broker again, because they're, again, talking to their lenders. They can advise you what your situation is today and what that might look like in 6 to 12 months' time.
And Verona, from your perspective, I mean, how long are transactions taking now? So I know there are going to be people watching this who might decide to take action. I know you guys touched upon bits of it earlier on, but from your perspective now, compared to where we were like pre-pandemic, what people were used to, what is the transaction time? And have you got any tips to try and get it pushed through a bit quicker?
That's a really good question. So there's two key parts in the transactions from the point that you list it on the market and the point that it sells. So that this time last year was taken around 62, 63 days. This year it's taken about 50 days. So that time to sell your property is shortening.
Okay.
Unfortunately, post that point when it goes sold subject to contract, that's taking probably 20 to 30 days longer than average. So it's taken up to 4 weeks longer. And that's because of all the impact on every other party within the transaction. So whether that's surveyors, local authorities, mortgage lenders, etc. If I'm being totally honest in terms of what a customer can do to help that situation right now, probably less requesting updates. Just let the parties in the transaction get on and do their job. That would be the number one thing I would say. If you're using a broker and an agent, liaise through them, get your updates through them. Don't keep going to the various different parties, because all that's doing is giving them more work to do to actually get the transactions through. That would be my advice.
And it goes without saying to you yourself just to react as quickly as you can. So if they ask for a document or they ask for that, just make sure you turn that type of stuff around as quickly as you
can. Let you not to be the fail point in the transaction, right?
Right. I mean, I'm conscious now the hour is up. We could have probably gone on for way longer. The questions are coming in, and we may have to do something like this again in the future, because clearly property is one of those topics that everybody is interested in, from whether they want to move or what they want to do in the future. So, I mean, thank you for all your input. I mean, it's been fantastic. The questions you've answered have been, I mean, the questions that we've been sent in by Money to the Masses readers and people watching this. So, yeah. So again, if this is, my guests were Verona, who is from Purplebricks, and Ben from Habito. Could you guys just go and give a quick roundup where people can go and find out a bit more about your companies as websites or anything like that, please?
Sure,
so,
absolutely.
Verona, you go first.
Mine is very obvious. It's purplebricks.co.uk, and we transact in all of the UK in both sales and lettings, and we also do mortgages. So, yeah. Thank you. Thank you for having us, Damien.
That's been brilliant. Yeah. And Ben?
And likewise, yeah, we're habito.com. We're online mortgage broker services and lender. So we're free for customers, and we're all online 24/7, 5 days a week. So yeah, visit us, whether that's in your lunch hour or on a Sunday night. So
likewise.
So thank you for everybody who has watched. If there is demand, we may do something like this again, because clearly it is a very popular live event. I'm just sorry that we couldn't actually do this in person, but property in a pandemic dictates that we have to do this remotely. There you go.